Hi, this is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Nathaniel Aikman. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer as many questions as we can. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment in research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service, available as a weekly updated printed publication or digitally, is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The survey includes data, charts, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The nation added an estimated 143,000 jobs in January. That figure fell short of the consensus forecast of 169,000 and was less than half the gain produced in December. Although the headline figure was disappointing, it doesn't tell the whole story about the state of the labor market. On the positive side, the prior two-month total was revised higher by an estimated 100,000 jobs, and the unemployment rate ticked lower from 4.1% to 4.0% last month. This likely puts little pressure on the Federal Reserve to resume cutting interest rates in the near term. Reducing the pace of consumer price growth has proven difficult in recent months. On point, the January Consumer Price Index and the core CPI, which excludes the more volatile food and energy components, rose 0.5% and 0.4%, respectively, on a month-to-month basis. The increase in the headline figure was the highest rate since June of 2022. On a 12-month basis, the CPI and core CPI increased 3% and 3.3%, respectively. The sticky inflation data followed a January employment report that showed an unexpected increase in the average hourly wage. That, combined with a drop in U.S. productivity in the final quarter of 2024, is concerning, as employers often pass along their higher labor costs to consumers through price increases. Meantime, the profit growth estimate for the final quarter of 2024 continues to rise, with north of 60% of the S&P 500 companies having reported as of press time more than 3/4 had exceeded expectations. The year-over-year earnings growth rate for the S&P 500 was averaging around 16%, up from 12% at the start of the season. That would mark the fastest pace of increase reported for the index in 4 years. This has provided some support for equities as concerns about monetary and fiscal policies build. Conclusion: with growing uncertainty about the near-term direction of both fiscal and monetary policies, equity market volatility cannot be ruled out. In this environment, a portfolio led by high-quality stocks may prove wise. Also, keeping a healthy amount of cash assets on hand gives investors the flexibility to buy on any notable dips. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content on markets, individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. See if we can do that. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line continues to review our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. For those of you that don't know, financial strength along with price stability are two metrics that are considered in calculating a stock's safety rank, a critical measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds, as many less talked about stocks are available at much more reasonable prices. Intro to screener one by Now let's move into one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and speculation on how far Washington will go in its economic policy changes. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with acceptable risk profiles. The first filter that we're going to look at right now is the industry rank in Value Line's top 10 ranks of industries. We're going to focus on stocks within industries that are among the top 10 ranked industries in the survey. By applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 365 candidates. The second filter is a timeliness rank of 3 or better. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy-to-understand scale from 1 to 5, with 1 being the best performing issues on a relative basis. Most often, stock buyers will want to avoid stocks ranked 4 or 5. After running this screen, we are down to 133 stocks. The third filter we are going to look at is the safety rank, which we would like to be 3 or better. This figure is a measure of risk and is on a scale similar to that of the timeliness rank. Our list is now down to 115 possibilities. The fourth filter is the 18-month target price range midpoint, and we are setting that at 25% or better. Now we want to look over the intermediate term, that is the 18-month time horizon. Scrolling up to the company data section, we're focusing on stocks with 18-month appreciation potential of 25% or better, which is well above the midpoint of our 18-month TPR, which is 13% currently. By applying this screen, we've chipped away at the list of prospects to 34 candidates. And lastly, our fifth filter is the dividend yield of at least 1.5%. This screen provides us with stocks whose earnings are less susceptible to surprises and therefore subsequent declines in theory. Our final list of candidates is now down to 12 candidates. You can make a strong argument for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we would prefer and recommend Sunoco, ticker symbol SUN. Before I click on Sunoco, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top of the page. Now let's click on Sunoco's last full-page report. Sunoco manages and distributes fuel products. Its fuel distribution and marketing business provides fuel and other petroleum products to third-party dealers, distributors, and independent operators, and to retail locations. Stock is ranked 3 for timeliness and 3 for safety currently. It possesses a very high yield of 6.2.1% and a B+ financial strength rank. The 18-month TPR is 25% with a trailing PE ratio of 7 times. Sunoco had a very good 2024. There were 4 key factors behind the company's performance. Number 1, the financial growth was strong as adjusted EBITDA for the full year was $1.56 billion, marking a 62% increase compared to the previous year. Secondly, the company made some key acquisitions for the year. In May of 2024, it acquired New Star Energy for $7.3 billion, adding about 9,500 of pipelines and 63 terminals to its portfolio. The company also expanded its European operations as well last year. Number 3, operational efficiency was robust for the year. Pipeline throughput and terminals performance climbed sharply on a year-over-year basis. Lastly, distribution growth was also healthy for the year. With that in mind, management is targeting a growth rate of at least 5% for 2025 in distribution. As noted, the company reported strong bottom-line results in 2024, and although earnings might well take a step back this year, we believe that this requires an explanation. Last year, Sunoco was firing on all cylinders, and thus it makes for a difficult comparison. We look for results to be strong both this year and next on an absolute basis. Policies from the Trump administration ought to be favorable for energy companies, which augurs well for profit growth. Overall, we think that near-term prospects are solid for Sunoco, and it is our one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation, and now I will hand it off to Alan and Nathaniel. Thank you.
Welcome, everyone. The first question came in is, what is financial strength? And that's a great question. A company's financial strength is a measure of its overall financial health and ability to withstand economic downturns or adverse conditions. This metric is crucial for investors as it indicates the company's capacity to meet its financial obligations, manage debt, and fund its operations without excessive risk. There are several components to financial strength. There's the balance sheet health, which includes debt levels, which is the amount of debt relative to equity, better known as the debt-to-equity ratio, and the company's ability to service this debt, which is known as the interest coverage ratio. There's also liquidity, which is availability of liquid assets to meet short-term obligations. They're often measured by ratios such as the current ratio or the quick ratio. There's also asset quality, which is the quality and valuation of the company's assets, including cash, receivables, and inventory. Another component of the financial strength is cash flow. There's operating cash flow, which is the cash generated from the company's core business operations, which is crucial for funding day-to-day operations and reinvestment without needing external financing. And also free cash flow, which is the cash remaining after capital expenditures, indicating how much cash is available for dividends, debt repayment, or reinvestment. There's also profitability component. This includes earning stability, which is the consistency in generating profits, which reflects the company's ability to maintain earnings over a period of time. There's also return on equity, which is a measure of how effectively the company uses shareholders' equity to generate profits. There's also credit ratings as another component of financial strength. These ratings are provided by the credit rating agencies, which assess the likelihood of a company defaulting on its debt. Finally, capital structure is a component of the financial strength. This is the measure of the mix of debt and equity financing used by the company, with a stronger financial structure typically having a lower proportion of debt. Another follow-up question is, what is the importance of financial strength? A company with strong financial strength is generally more resilient to economic downturns, can take advantage of growth opportunities, and is less likely to face financial distress. Conversely, a company with weak financial strength might struggle during tough economic times and could be at risk for possible bankruptcy. We had another question come in. Could you please describe the timeliness ranking system in more detail? And this is an excellent question. The Value Line timeliness ranking system measures predictive relative price performance of the approximately 1,700 stocks that are in our survey during the next 6 to 12 months on an easy to understand scale from 1 highest to 5 lowest. Components of the timeliness rank include such items as the trend of relative earnings and prices, along with earning surprises. All data are actual and known. A computer program combines these elements into a forecast of the price change of each stock relative to the approximately 1,700 stocks for the next 6 to 12 months. We advise subscribers should focus on companies that are ranked at least 3 or better for timeliness. We update timeless ranks each week, so investors should pay close attention to stocks that they are interested in. There's another question that just came in. Is Sunoco an upstream, downstream, or midstream company? What is the difference between them? Sunoco is primarily a downstream company. It focuses on fuel distribution, marketing, and retail operations rather than exploration, production, or transportation of crude oil. Sunoco distributes petroleum products to gas stations, convenience stores, and other fuel outlets across the United States. While it does have some logistics assets, its core business is the downstream sector. And to differentiate the three, upstream is more associated with exploration and production. Its focus is on finding and extracting crude oil and natural gas. Activities include drilling, exploration, and production of oil and gas from underground reserves. Companies that are examples are ExxonMobil, Chevron, and Schlumberger. Midstream is primarily responsible for transportation and storage. The focus is on moving crude oil and natural gas from production sites to refineries and markets. Activities include pipelines, storage facilities, and transportation via tankers, rail, and trucks. Examples of midstream companies include Kinder Morgan, Enbridge, and Enterprise Products Partners. Finally, downstream is primarily involved in the refining and distribution. The focus is on refining crude oil into finished products and distributing them to consumers. Activities include refining crude into gasoline, diesel, jet fuel, petrochemicals, and lubricants, marketing and selling these products. Examples of such companies are Sunoco, Valero, Marathon Petroleum, and Shell's retail division. Thank you.
I've got a question here. Are 3 to 5 year projections the best way to screen for buy and hold long-term appreciation stocks? And I mean, the answer is obviously we can't recommend using any single metric to make these decisions, right? There's a reason when we're doing these screens that we have several different metrics that we do each time. However, the 3 to 5 year price projections are generally going to be one of your more important ones if you're looking for a long-term appreciation stock because, you know, the end goal is to make money. You want a company that's going to make money over that time frame, but it's important to look at other factors like, for example, depending on your risk tolerance, you might look at the safety rank, the financial strength rating, things like that. It's important to look at, you know, the overall structure of your portfolio, like how diversified are you? Is there anything that you particularly need? So as always, you know, you'll want to look at a plurality of factors, but for that particular case, this is generally going to be one of them. But again, you have to look at it in the context of all those other things.
This is Alan again. I see another question that came in. What is our threshold for high quality stocks? And this is it's quantitative, but it's also a qualitative question. It's, you know, I would say high quality stocks are ranked at least 2 for safety, and I would say at least an A for financial strength. That would probably be 2 parameters that I would pay special attention to. You know, each person's view of high quality stocks are a little bit different, but I would say they're pretty good parameters. I would say at least a 2 for safety and at least an A for financial strength. Of course, I would also pay attention to the stock's price stability ranking and the earnings predictability for the company. That should also be high, probably at least 80 or above. So I think there's some factors that would make stocks high quality from my perspective. Thank you.
Yeah. I think that's our questions for today.
Well, thank you for joining us. We'll send it back to Peter.
Thank you, and thank you everyone for joining the webinar. This does conclude today's event. You may now disconnect your lines and have a great day.